Right now, a critical fracture is opening in the financial markets. For the second time in just 72 hours, the CME has issued an emergency margin hike. At the same time, major dealers worldwide are shutting down, unable to source physical silver. This Monday, we will witness a direct conflict between two completely opposing realities: the paper market and the physical market. One of them is about to break. The CME is raising margin requirements once more. This marks the second increase in only 3 days. The initial adjustment took effect on January 28th. Now, effective Monday, February 2nd, that's tomorrow, maintenance margins are being elevated again. From the levels established just 72 hours prior, gold margins are climbing an additional 33%, silver is up another 36%, platinum another 25%, and palladium another 14%. These are sequential hikes layered on top of the previous increase. The capital required to maintain one silver contract surged from approximately $25,000 before the first hike to about $66,000 after January 28th. And now, it ascends even higher come Monday. This signals desperation, and tomorrow's market opening will be absolutely pivotal. But here's what makes Monday even more extraordinary. Throughout this past week, sourcing physical silver has become difficult to nearly impossible. Tory Person, founder of Bullion Star, posted a trading update on Saturday stating it remains uncertain if they can acquire any additional silver inventory. Golden State Mint halted silver sales for the weekend, unable to secure metal. The last time conditions resembled this was during the COVID panic. The UK's largest precious metals refiner and retailer Baird & Cozen has suspended online sales. The physical silver market is decoupling from the paper market, and Monday's opening will reveal whether the paper structure holds or shatters completely. An important note for new viewers before we proceed: I do not sell signals, mentorships, memberships, or anything else. If anyone claims otherwise, block them immediately. I present the unfiltered picture here. I do not trade in hype, fear, or greed. I've received countless messages that this content helps you see both sides, comprehend the data, grasp what is truly occurring, and make more informed decisions. I operate solely on X and YouTube. My handle on both is OGJohnAG. That is the only authentic source. I am not accountable for any other. Protect yourself. I will never attempt to sell you anything. Now, I want your perspective. Comment below with OGJohnAG and your outlook. What is your forecast for silver next week? What is your instinct telling you for Monday? Let's connect the threads from this entire week to the current moment. On Friday, we witnessed a metals crash. Silver plunged 31%, its largest single-day loss on record. I showed you that JP Morgan closed 633 silver short contracts precisely at the bottom, a perfectly timed exit. We discussed Kevin Warsh's selection as Fed chair, his anti-QE stance favoring rate cuts paired with balance sheet reduction. Markets sold off on this policy pivot away from limitless liquidity. Now, the CME hikes margins for the second time in 72 hours, immediately following massive volatility and some of the sharpest price declines we've observed. The official justification is enhanced risk coverage, but traders interpret the size and timing as a deliberate maneuver to squeeze out over-leveraged long positions. The expense of maintaining open positions is soaring, which may trigger further forced selling or violent price swings. Here's what I am monitoring. Shanghai spot silver currently trades at 122.13. COMEX silver sits at 85.33. The Shanghai premium is 36.80, a 43.13% premium. On China's premier e-commerce platform, JD.com, gold bars sell for roughly $57.20 per ounce. Physical silver bars are listed at $163.35 per ounce. That represents a 91% premium to US COMEX prices. Let me restate that: JD.com silver at 163, COMEX at 85, a 91% premium. The divergence from fundamental silver value is at its most extreme. Based on supply-demand fundamentals, silver should be near $130. Every historical instance of a 30% discount from fundamentals has been followed by a powerful rebound. This silver backwardation must resolve. You cannot have physical metal trading at 91% premiums while paper markets crash. One of these markets is profoundly wrong, and the physical market is screaming that the paper market is the incorrect one. Bullion Star, difficult to near impossible to source physical silver. Golden State Mint shut down, not able to secure silver. Baird & Comer UK shut down online sales. Throughout this period of market revaluation, dealers have witnessed extreme and unprecedented physical demand. At the same time, replenishment options have become increasingly scarce, with physical metals drying up and mints operating under enormous backlogs. In such an environment of constrained supply and sustained physical demand, sharp price declines in the paper markets are difficult to reconcile with the realities of the physical precious metals market. That is a direct quote from Bullion Star. Physical demand is extreme. Supply is constrained, mints are backed up, and paper silver crashes 31%. This is the disconnect we have tracked all week, and Monday's opening will test whether it persists or finally breaks. Now, let's address Bitcoin. In my prior video, I said to watch if Bitcoin closed the weekend above $82,000 or fell below. A close above would be bullish for Monday. It closed at $78,000. This is my personal analysis, but it appears weak. Bitcoin is at $78,000 presently. If Monday's opening lacks strength, Bitcoin could decline to $74,000 or lower. A break below $74,000 would push Michael Saylor's MicroStrategy underwater, a psychological threshold that could ignite further selling across crypto and risk assets. Therefore, the Asian opening tonight is paramount. Shanghai futures, Hong Kong, and Tokyo markets open first. If Shanghai silver holds at $122 or rises while COMEX is closed, it signals physical markets are not panicking despite the margin hikes. If Shanghai gaps down, following COMEX lower, it indicates selling pressure is global. The Asian Open establishes Monday's tone. Now, reviewing the numbers, roughly 75% of viewers are not subscribed. If this unfiltered real-time analysis cuts through the noise, provides you a clear edge on the complete narrative from both sides, and aids your decision-making, please subscribe. That is how we grow a community founded on truth, not hype. If this adds value, drop OG John AG in the comments. It helps identify what matters to you and keeps this channel anchored in reality. If this isn't for you, no offense taken. I do not chase empty metrics. I am here for those seeking clarity apart from the polished mainstream hype. I will not promise it's going to the moon nor claim it's going to zero. I serve those who want substantive clarity, not the scripted, shallow commentary found elsewhere. We are observing two diametrically opposed realities. Paper reality. CME hiking margins twice in 3 days. Silver down 31% Friday. Warsh chosen as Fed chair. Policy analysis suggests bearish for metals. Dow futures down 300 points as the Kevin Warsh sell-off continues. Options traders are now the most bearish on the US dollar in history. Physical reality. Silver 9 consecutive months green. Its longest winning streak ever. Gold 7 consecutive months green, its longest winning streak ever. Dealers shutting down due to inability to source metal. Shanghai premium at 43%, JD.com premium at 91%. China's gold imports from Russia hit a record high. Physical demand termed extreme and unprecedented by dealers. One of these realities will overwhelm the other on Monday. Either paper margin hikes force more liquidation and paper wins short term, or physical scarcity becomes undeniable and paper loses all credibility. Monday's opening will declare the victor. And then there is Iran. The Americans should know if they start a war, this time it will be a regional war. That is a direct quote from Iran's mission to the UN. A U.S. administration figure stated troops and warships were deployed. Qatar's foreign minister delivered a final message to Iran's supreme leader, who responded, "We will not start a war, nor do we wish to attack any country, but our people will deliver a powerful blow to anyone who attacks them." Escalating Middle East geopolitical tensions could serve as another catalyst for precious metals. If tensions flare overnight or Monday morning, safe haven flows might override the selling pressure from margin hikes. Let's address both potential scenarios for Monday, as this is binary. Bearish case first. CME margin hikes take effect Monday. Traders who survived Friday's crash must now post 33% more capital for gold, 36% more for silver. Inability to comply triggers forced liquidation and more selling. Paper price drops further, ignoring physical scarcity. Friday's price action felt like forced liquidation versus fundamental selling. Monday could see a repeat. Bitcoin at $78,000 appears weak. A break below $74,000 sinks Saylor, prompting broader crypto sell-off. Risk-off sentiment spreads to all assets. Asian markets gap down. European markets follow. US markets open weak. Dow futures already down 300. The selling cascades. Warsh policy analysis suggests extreme bearishness for metals. A stronger US dollar raises metal costs for international buyers. The primary rationale for holding gold, hedging against money printing, diminishes if the Fed shrinks its balance sheet and turns off the printing press. Iran tensions could escalate. Any military incident triggers panic selling before safe haven buying emerges. Phase 1 liquidation continues. Everything sells as participants scramble for cash. Margin calls hit across asset classes. The $15 trillion erased Friday could become $20 trillion Monday as contagion spreads. This is the bearish scenario. Paper overwhelms physical short term, causing more pain before any recovery. But here is the bullish case. JP Morgan covered shorts Friday at the bottom. Major banks have exited. Short interest is now lower, reducing suppression on the next upward move. Physical holders in China and India refuse to sell at $78.90. They are holding. Dealers cannot source metal. Mints are backed up. This constructs a solid floor. The physical reality cannot be ignored indefinitely. The CME margin hikes may be a final, desperate action, protecting clearing firms from a troubled major player. Afterwards, if physical demand remains unbroken, if Shanghai premiums hold at 43%, if JD.com stays at 91%, the COMEX pricing system loses all credibility. Monday could be the inflection point where physical prevails. Silver is 9 straight months green. Gold is 7 straight months green, the longest winning streaks in history. Friday's 31% crash did not terminate the bull market. It was forced liquidation, not fundamental selling. Historically, every 30% discount from fundamentals has precipitated a bounce. History indicates this is a buying opportunity, not the end. Bitcoin at $78,000. If Asian markets stabilize, if Bitcoin holds and rebounds toward 82, 85K Monday morning, sentiment shifts, risk on returns, crypto stabilizes, liquidation ceases. Iran tensions could de-escalate if diplomacy succeeds. The message Qatar delivered might lead to a deal, no military strikes. The geopolitical premium dissolves and markets rebound. The financial conditions index has fallen to 98.3, its lowest since early 2022, indicating loosening conditions. The Fed has cut rates by 175 basis points since September 2024. The dollar is down 12% over 12 months. Investment-grade credit spreads are the tightest since 1998. Financial conditions have returned to pre-rate hike levels. Asset owners are winning. This is the macro backdrop supporting higher asset prices once forced liquidation abates. And here is the actual nuance regarding Warsh. Markets may misread him as a hawk. His true stance is complex. He is bullish on AI and productivity, believing AI-driven gains permit rapid economic growth without inflation. This provides cover to support rate cuts even amid economic strength. He is not as bearish as the knee-jerk reaction implies. He desires rate cuts but also demands balance sheet discipline. Rate cuts without QE may impair short-term liquidity, but it is not the bull market's death knell. So Monday boils down to this: the Asian opening tonight, Bitcoin's overnight action, Iran-related news, and whether CME margin hikes trigger more forced selling, or if physical scarcity finally overwhelms paper manipulation. I am watching Shanghai futures intently. If Shanghai silver holds $122 or rises, that is bullish. A hard gap down is bearish. Bitcoin must hold $78,000 at a minimum. A break below $74,000 is problematic. Iran must remain in the diplomatic channel. Any military escalation Monday morning changes everything. Where does this leave us? 3 key takeaways, and we conclude. 1. CME margin hike, second in 3 days. Gold up 33%, silver up 36%, effective Monday. This could force more liquidation or represent the final desperate move before physical wins. Physical dealers are shutting down. Bullion Star cannot source. Golden State Mint cannot secure. Baird UK closed online sales. Shanghai Premium 43%, JD.com Premium 91%. Paper and physical are utterly disconnected. Monday's opening decides which reality prevails. 2. Bitcoin at $78,000 looks weak after I highlighted a close above $82,000 is key. If Monday shows no strength, $74,000 or lower becomes probable. The Asian opening tonight is critical. Shanghai futures, Hong Kong, Tokyo open first and set the tone. Shanghai silver holding or rising is bullish. Gapping down is bearish. The 12 hours preceding Monday's US Open will reveal everything. 3. Warsh's policy is more nuanced than the initial bearish reaction. He is dovish on rates, bullish on AI productivity, but disciplined on the balance sheet. Not as extremely bearish for metals as Friday's sell-off implied. Iran tensions could escalate or de-escalate. Silver's 9-month streak, gold's 7-month streak, the longest in history. Friday was forced liquidation, not fundamental. History shows 30% discounts from fundamentals bounce back, but Monday's opening will confirm or deny that pattern. The unresolved tension is this: physical scarcity is extreme. Dealers are shutting down. Premiums are 43% to 91%, yet paper margins are hiked twice in 3 days, forcing more selling. Bitcoin is weak at $78,000. Iran tensions are elevated. Monday opens with all these forces converging. Does physical reality finally overwhelm paper manipulation, or does one more wave of forced selling arrive before the snapback? This is the most critical opening we have faced all year. Asian markets tonight, US markets Monday morning. Every theme tracked this week: JP Morgan's exit, Warsh policy, physical scarcity, margin hikes, Iran tensions, culminates tomorrow. Stay sharp. Watch the data. The next 24 hours will determine if this was the final flush or if we see another leg down before physical prevails. Conduct your own due diligence. Understand the risks. Be accountable for your decisions. Have a clear plan and know your time frame. Are you trading on an hourly chart or investing on a yearly thesis? Plan and position accordingly. If you are over-leveraged, margin hikes will force you out irrespective of the long-term outlook. But if you are positioned appropriately and comprehend the situation, whether you are stacking and waiting for further declines to accumulate more, as many here with decades of experience are doing, then let's observe what Monday's opening delivers. Time will tell. However, if you are new and lack a plan, these volatile environments can destroy you. Invest with logic, not hype. Use your intellect. Do not follow anyone blindly. OG out.